Some Canadian ETFs advertise distribution yields around 10% or even higher. That can look incredibly attractive. Put $100,000 into a fund paying roughly 10% annually, and the headline number suggests close to $10,000 of cash distributions over a year. But there is a crucial question hiding behind that yield. Where is the money actually coming from? Because a 10% distribution is not the same thing as a 10% investment return. And with covered call ETFs, understanding that difference can completely change how you evaluate the fund. This video is for educational purposes only and is not personalized financial, investment, tax, or legal advice. Covered call ETFs use an option strategy that has existed long before these products became popular with Canadian retail investors. The basic idea is fairly straightforward. The fund owns shares. Then it sells or writes call options against some of those shares. A call option gives the buyer the right to purchase the underlying security at a predetermined price within a specified period. In exchange for selling that option, the fund receives an option premium. That premium creates additional cash flow. But it comes with a trade-off. If the stock rises above the option's strike price, the fund may give up some of the upside on the portion covered by those options. The exact mechanics depend on the strategy. Some funds write options on a relatively small portion of their holdings. Others use substantially more coverage. Strike prices, expiration dates, and option coverage can change. So saying that every covered call ETF writes options on 1/3 or 1/2 of its portfolio would be too simplistic. The important principle is this. The more upside a fund sells through call options, all else equal, the more potential option premium it may collect, but the more upside participation it may sacrifice if the underlying stocks rise strongly. That is the basic trade. More current cash flow in exchange for giving up some potential future appreciation. Canada has had covered call ETFs for quite a while. BMO launched the BMO Covered Call Canadian Banks ETF, ticker ZWB, in 2011 and described it at the time as the first covered call strategy offered by a Canadian ETF provider. Since then, the category has expanded significantly. Today, there are covered call ETFs focusing on banks, technology, utilities, energy, broad equity markets, and other sectors. There are also funds that combine covered calls with other strategies. Two examples that frequently attract attention are HMAX and HDIV from Hamilton ETFs. But these two funds should not be treated as though they are identical. HMAX is the Hamilton Canadian Financials Yield Maximizer ETF. It owns a concentrated portfolio of major Canadian financial companies and uses an active covered call strategy. Importantly, HMAX currently does not use leverage. HDIV is different. HDIV is the Hamilton Enhanced Canadian Covered Call ETF. It invests primarily in other covered call ETFs focused on Canadian sectors, and currently uses approximately 25% cash leverage. That leverage can increase income and upside exposure. It can also magnify losses. So even before looking at the distribution yield, investors need to understand that these are different structures with different risks. As of June 30th, 2026, Hamilton reported an annualized distribution yield of approximately 11.1% for HMAX and approximately 9.8% for HDIV. Those figures can change. They are not guaranteed, and they are not forecasts of total investment return. Hamilton's published yield calculation annualizes the most recent distribution relative to the unit price. That is another important distinction. A displayed distribution yield is not necessarily the fund's return over the previous 12 months. Different providers can also use different yield definitions, so investors should always check exactly how the number is calculated. Now we get to the part that causes the most confusion. What is actually inside a covered call ETF distribution? Potential sources can include dividends from the underlying stocks. They can include gains associated with the option strategy. They can include realized capital gains. They may include other income. And for tax reporting purposes, some of the distribution may be classified as return of capital. But there is a major mistake we need to avoid here. Return of capital does not automatically mean the fund simply failed to earn enough money and handed the investor their own principal back. Sometimes that is effectively what can happen. But return of capital is also a tax classification, and the tax classification of a distribution is not necessarily identical to the economic source of the cash. Hamilton itself provides a useful example of this distinction. Suppose a covered call fund earns option premiums. Those option transactions may create capital gains for tax purposes. But suppose the fund also has realized or carried forward capital losses available. Those losses may offset the capital gains. The fund can still distribute cash that was economically generated through the option strategy, while some or all of that distribution is ultimately reported as return of capital for tax purposes. In that situation, seeing return of capital on a tax slip does not automatically prove that the fund destroyed an equivalent amount of economic value. That is why simply looking at the return of capital percentage and saying, "This is just your own money coming back," can be misleading. The correct question is broader. What happened to the fund's total economic value? That means looking at both distributions and changes in net asset value. There is another misconception worth clearing up. When an ETF pays a distribution, its net asset value normally falls by approximately the amount of that distribution on the X distribution date, all else being equal. That basic adjustment happens whether the distribution is characterized as dividends, capital gains, income, or return of capital. So seeing the unit price adjust after a distribution does not, by itself, prove that capital is being eroded. What matters over time is total return. Price change plus distributions. If a fund starts at $20, pays $2 in distributions, and finishes the period at $21, the investor did not lose $2 simply because cash was distributed. On the other hand, if a fund repeatedly distributes large amounts while its underlying economic performance cannot support those distributions, then the investor's capital can indeed decline. That is the risk people are trying to describe when they talk about destructive return of capital. But the distinction matters. Return of capital on a tax slip and economic destruction of capital are not the same concept. In fact, Hamilton's own historical tax reporting illustrates how significant the classification can be. For 2025, a large portion of the distributions reported for both HMAX and HDIV was characterized as return of capital. But Hamilton also explicitly explains that distribution classifications can change from year to year, and that return of capital can arise because of the interaction between option gains and available capital losses. So you cannot evaluate these funds from one tax category alone. Now let's look at the tax side. In a non-registered Canadian account, return of capital is generally not included in taxable income when received. Instead, it generally reduces the adjusted cost base of the investment. Suppose someone purchases ETF units for $100,000 and later receives $5,000 that is classified entirely as return of capital. Ignoring other transactions, the adjusted cost base may fall from $100,000 to $95,000. That lower adjusted cost base can increase the capital gain eventually realized when the investment is sold. And if adjusted cost base is reduced below zero while the units are still owned, Canadian tax rules can trigger a capital gain. So calling return of capital tax-free income is incomplete. It is often better described as tax-deferred in this context because it can reduce adjusted cost base and affect future capital gains. Inside an RRSP or TFSA, the tax accounting works differently because investments inside registered accounts are generally not tracked for Canadian capital gains tax using adjusted cost base in the same way as investments in a regular taxable account. But that does not make economic performance irrelevant. Whether a distribution is labeled return of capital or something else, an investor should still care about what is happening to the total value of the investment. Now let's return to covered calls themselves. Why can these funds lag during strong bull markets? Imagine a stock trading at $100. A fund owns the stock and sells a call option with a strike price of $105. The fund receives a premium. If the stock barely moves, that premium can improve the fund's result relative to simply holding the stock. If the stock declines moderately, the premium can also provide a small cushion. But it is only a cushion. It does not prevent losses. If the stock collapses, the fund can still lose substantial money. Now imagine the stock suddenly jumps from $100 to $120. A plain investor owns the entire $20 increase. The covered call strategy may not capture all of that upside on the portion covered by the option. That is the cost of having collected the premium. So covered calls tend to look particularly attractive when markets move sideways, rise moderately, or when option premiums are relatively rich. They can be less attractive during powerful rallies, where the underlying stocks move far above the strike prices. But even that is not a universal prediction. Outcomes depend on option coverage, strike selection, volatility, sector exposure, timing, fees, leverage, and market conditions. Covered calls do not automatically underperform every bull market, and they do not automatically outperform every bear market. The mechanics simply change the return profile. That is why comparing a covered call ETF with a plain index ETF can be useful. Take BMO's Canadian bank funds as an example. ZEB is the BMO Equal Weight Banks Index ETF. ZWB is the BMO Covered Call Canadian Banks ETF. Both provide Canadian bank exposure, but ZWB overlays a covered call strategy. According to the 2026 ETF facts documents, ZEB reported an MER of approximately 0.28%. ZWB reported an MER of approximately 0.72%. So the covered call version has additional costs, but fees are only part of the comparison. Investors should compare total returns over the same period, and total return means including distributions. Simply looking at the price chart can make a high distribution ETF appear worse than it really performed, because part of the return has already been paid out in cash. Likewise, comparing only distribution yields can make a covered call ETF appear much better than a lower yield index fund, even if the index fund generated greater overall wealth. Both comparisons can be misleading. The more useful question is this: if $10,000 had been invested in each fund over the same period, with distributions reinvested, how much would each investment be worth? That comparison captures both capital appreciation and distributions. It also needs to be done over a common period. That is especially important with newer ETFs. HMAX began in January 2023. HDIV began in July 2021. So telling someone to automatically pull up a 5-year chart for HMAX does not work, because HMAX does not yet have a 5-year live history. Use the longest meaningful period both investments actually share, and make sure the benchmark is appropriate. Comparing a leveraged multi-sector covered call fund with an unleveraged single-sector index and then attributing every difference to covered calls would not be a fair test. You need to compare similar exposures whenever possible. Now let's talk about leverage. This is particularly important with HDIV. HDIV currently uses roughly 25% cash leverage. That means the portfolio has greater investment exposure than the amount of investor equity alone would provide. Leverage can enhance returns when the underlying investments perform well. It can also magnify losses when they fall. And borrowing has costs. So a leveraged covered call ETF is not simply a normal ETF with a larger monthly distribution. It combines several separate return drivers: underlying equities, option premiums, dividends, borrowing costs, fund expenses, and leverage. That is a much more complicated machine than a traditional broad market index ETF. HMAX, by contrast, currently does not use leverage. Again, knowing the ticker is not enough. You need to know the structure. The same principle applies to fees. Do not assume every covered call ETF has the same fee. And do not compare a management fee from one fund with the MER of another as though those numbers are identical. The management fee is one component of fund expenses. The MER is a broader measure that incorporates the management fee and certain operating expenses and taxes. Leveraged products can also have financing costs that need to be understood separately or through the fund's disclosures. So when comparing costs, make sure you're comparing the same metric. Now we come to the biggest question. Who might actually consider a covered call ETF? The answer is not simply retirees, and it is not simply people who want monthly income. A covered call strategy may appeal to some investors who deliberately value current cash distributions and are willing to give up some potential upside in exchange. That could include some retirees. But retirement alone does not automatically make a high distribution covered call ETF appropriate. A retiree still needs to think about total return, inflation, portfolio longevity, sequence of returns risk, tax consequences, diversification, liquidity, and how much of the portfolio will be withdrawn each year. A 12% distribution does not mean a retiree can safely spend 12% of the portfolio every year indefinitely. Those are completely different concepts. If the portfolio earns less than it distributes over time, and the investor spends every distribution, capital may decline. And if capital declines enough, future distributions can become harder to sustain. That is why distribution rate should never be confused with a safe withdrawal rate. The same caution applies to younger investors. It would be too broad to say that everyone in their 30s or 40s should avoid covered call ETFs. Age alone does not determine portfolio suitability, but someone with a long accumulation horizon who does not need current cash flow should understand the opportunity cost of continually selling part of the portfolio's upside. A broad equity ETF, focused primarily on long-term total return, may fit that objective differently from a covered call fund designed to emphasize distributions. Neither approach is automatically correct. They solve different problems. And there is no universal rule saying a covered call ETF should make up 5%, 10%, or any other fixed percentage of a portfolio. The appropriate allocation, if any, depends on the investor's objectives, risk tolerance, other holdings, income needs, and time horizon. So before buying a high distribution ETF, there are a few questions worth asking. First, what does the fund actually own? Canadian banks? Technology companies? A portfolio of other ETFs? A broad market? One sector? Multiple sectors? The yield number tells you almost nothing about diversification. Second, how does the covered call strategy work? What percentage of the portfolio can be overwritten? How are strike prices selected? Is the strategy systematic or actively managed? How much upside can potentially be given away? Third, does the fund use leverage? HMAX currently does not. HDIV currently does. That difference alone changes the risk profile. Fourth, what are the actual costs? Look at the MER when available. Look at the management fee. And if leverage is involved, understand that financing costs matter too. Fifth, examine the distribution history and annual tax information, but do not automatically interpret return of capital as proof that the fund is failing. Understand why the distribution received that tax characterization. Then look at the fund's net asset value and total return. Sixth, compare the fund against an appropriate alternative over the same period. Include reinvested distributions. Do not compare yield with yield. Compare wealth with wealth. And finally, ask the most important question. What job is this investment supposed to perform? If the goal is maximizing monthly cash flow, a covered call ETF may deserve consideration. If the goal is maximizing long-term capital growth, repeatedly selling upside may be less attractive. If the goal is reducing risk, do not assume a high-income equity ETF is a substitute for bonds or cash. Covered calls can change the shape of equity returns. They do not eliminate equity risk, and leverage can increase that risk. That is the real lesson behind these eye-catching distribution yields. A fund displaying 10 or 11% is not necessarily generating 10 or 11% of new wealth every year. But the opposite extreme is also wrong. A distribution containing return of capital is not automatically fake income or proof that the fund is collapsing. You need to look underneath the headline number. Underlying investment return, option premiums, capital gains and losses, distribution policy, tax characterization, fees, leverage, and changes in net asset value. Put those pieces together, and the strategy starts to make sense. Covered call ETFs are legitimate investment products designed to produce a different balance between current distributions and future upside. That trade-off can be useful for some investors. It can be unnecessary for others. The important thing is not to buy the yield. Understand the machine producing it, because the number landing in your account every month is only half the story. The other half is what happened to your total wealth while that cash was being paid. If you're comparing a Canadian covered call ETF, start with that question. Not, how much does it pay? Ask, what is my total return? What risks produced it? And what am I giving up to receive that distribution? That is the comparison that actually matters. Subscribe for more Canadian investing breakdowns, and I'll see you in the next one.